Welcome to Looking at the Markets with David Moadel. Today I'm going to try to answer a question that I get quite a bit. I bought a stock or option and it went down. What do I do now? Yikes! Every experienced trader or investor knows the feeling. You buy a stock or ETF or option, and the next thing you know, the trade is going against you. Sometimes it feels like the market is purposely conspiring against you. The time to ask what to do when the trade goes against me is not after you made the trade. The time to ask that question is before you make the trade. Prior to making any trade, you need to decide beforehand whether you're going to A, use a stop loss order, which can either be automated through your broker or it could be a mental stop loss order, or B, just ride it out and possibly even average down or buy some more at a lower price. So which to choose? If you're buying options or option spreads and your maximum loss is the amount that you paid for the option or the spread, then you can either establish a stop loss when placing the buy order, or you can just decide beforehand to ride it out, especially if you took a small position size, which I always recommend. If you decide beforehand to ride it out, then be emotionally ready to lose your entire investment on the trade. Now, that might sound dramatic, but it's not the end of the world if you took a small position size. Whether you use a stop loss order or just ride it out, deciding beforehand can help you avoid the "my trade went against me, what do I do now" issue. Now, what about selling options? Well, if you're selling options, then you might want to limit your maximum potential loss, either by making it into a spread or by using a stop loss order, establishing how much money you're willing to lose on the option sale before you buy back and close the position. Or if you're selling cash secured puts, for example, then you can just accept beforehand that you'll be glad to buy the asset at the specified strike price. If you're having difficulty accepting that, then should you really be entering the trade? Probably not. Okay, so that was options. What about stocks or ETFs? If you're buying stocks or ETFs instead of options, then whether you choose to use stop loss orders or just ride it out depends largely on your time horizon. For example, a long-term buy and hold investor will probably just ride out the drawdowns, whereas day traders are more likely to use stop losses. Now, swing traders will typically want to use stop losses unless they're emotionally ready and willing to convert to long-term investors when big drawdowns occur. Again, these decisions need to be made, I'll say it again, before the trade, not after. If you didn't take my advice and just made a trade without an exit plan, or at least a purposeful plan not to exit, if you're going to ride it out, now you'll have to retrofit a plan onto your existing trade. Not fun, right? Riding it out is only recommended if you can stomach further losses. Averaging down, or buying more at a lower price after a trade goes against you, might not be a terrible idea if you had planned it ahead of time, and if you had a medium to long-term time frame, and if it's a blue chip mega cap stock or ETF that consistently recovers over time. If those conditions aren't met, then usually your best move is to accept the loss and move on. Most importantly, learn from the experience and do not, I repeat, do not revenge trade, because that is a form of emotional trading that can lead to devastating losses. When trades go against you, planning ahead of time really pays off. An ounce of prevention is worth its weight in gold when your losses are limited and your peace of mind remains intact. So if you want more help with this, if you just need some advisement or just somebody to talk to about your finances, options, stocks, investing in general, please feel free to contact me, davidmoadel at gmail.com. Hope to talk to you soon. Thanks a lot.